faithfully delivering value, interpreting the world's great books. Hi, this is Sally's Book Talk. Today, I'm going to interpret this book for you, The Little Island Economics. It's by the Schiff brothers, Peter and Andrew Schiff. Back in 2008, a sudden financial crisis dragged America into a deep pit. Stocks tanked, banks went bust left and right, job losses shot up, home prices crashed, and folks in America started dealing with crazy tough times. Out in California, homeless folks ended up in tents, basically camping out day and night. Folks around the globe were shocked. Why did a financial crisis beat down mighty America so bad? So what caused this economic mess in America? Today's book came out in 2009 after the subprime mess. The authors wrote this fable to help folks understand why America's economy crashed, because the authors put the story on a tiny island. The Chinese edition got the name Little Island Economics. The Schiff brothers packed America's economic history into this little island tale. They think government meddling screwed up the economy big time. All crises should fix themselves through the market. But these ideas clash with mainstream economics. So yeah, once this book hit the shelves, it caused a big stir. But hey, all the data aside, why do economies crash? Peter Schiff knows his stuff. He nailed the 2008 crash prediction. Right now, he's the big boss at Euro Pacific Capital. As an investor, he's lived through market ups and downs. This book is his baby. Since it came out, it's stayed on Amazon's bestseller list for more than 60 weeks. The story's lengthy and packs in lots of insights. I'm going to split the key stuff into two parts for you. First up, how'd the island economy grow? Second, how did it all fall apart? First off, let's dive into how the island got its economy rolling. So here's the island story. Way back, just 3 folks lived there fishing for a living, but each one could only snag 1 fish per day. Obviously, in this situation, there was no economy to speak of on the island. Later, a guy named Abe made a fishing net. This way he could catch 2 fish a day, so he had 1 extra fish as his savings. Even if Abe skipped fishing for a day, he could still fill his belly using his savings. The other 2 guys saw this and got really jealous. They wanted to make nets too. So they went to Abe to borrow fish, promising to pay back double the next day. Abe realized he could earn 2 fish without doing anything. So he agreed. The 2 guys ate the borrowed fish and quickly made their own nets. Soon after, the nets were done, and the island could catch 6 fish a day total. Productivity shot up. To live better, the 3 made a bigger, giant fish trap. Although they ate all their saved fish during the making of the trap, they succeeded in the end. The new trap worked automatically, catching 20 fish a week. Soon, they made a second giant trap. Now, the island's productivity went even higher, and the 3 had more time to do what they wanted. By this point, the island had 2 foundations for economic growth: production and savings. The role of production goes without saying. Let's focus on what savings do. First, savings boost personal spending power and can promote production through lending. Imagine if Abe hadn't lent his savings to the other 2. The island's economy would have grown much slower. Plus, savings help prepare for rainy days and fight risks. So, Abe and the other 2, if they hadn't had savings before, they might have starved before finishing the fish trap. Similarly, if a hurricane hit the island and wrecked all the traps, as long as they had enough savings, the 3 could rebuild them and the economy could recover. That covers the foundations of economic development. Now, let's see how the island's economy developed. In the first stage of economic development, job specialization and money appeared. The good life of Abe and the 3 attracted many immigrants to the island who also wanted a better life. Some new immigrants learned to fish, others borrowed fish from Abe to fill their bellies, then cultivated land to grow crops. Some used savings to hire others to work. The island's productivity greatly developed. So some people didn't have to fish or farm to survive, and the service industry emerged. For example, some became chefs, others took jobs like construction workers, surfing instructors, etc. This is job specialization. As society developed, people needed a medium of exchange to pay for services. At this time, everyone on the island ate fish, so fish naturally became the currency. It could be used to buy goods and services. The appearance of currency greatly promoted business growth and increased personal savings. From then on, the island entered its second stage of booming development, founding banks and increasing loan investments. As islanders stored more and more fish, fish thieves became more common. Storing fish became a big problem, and more people wanted to use their saved fish for investments. Just then, a guy named Good Bank built a huge storage room on the island, hired the strongest guards, and urged everyone to put their fish in his storage. At the same time, islanders could borrow fish from Good Bank. Of course, borrowing fish meant returning more fish. This is the savings and lending we're familiar with now. Your bank would return part of the lending profits as interest to depositors and use another part to pay the guards' wages. Finally, he could keep some profit for himself, and thus the island's first bank was born. The island's economy boomed rapidly due to bank loans and investments. Among many projects, Good Bank preferred infrastructure projects because they were always very safe. In the story, Good Bank invested in a water plant project that covered the whole island's water supply. Islanders paid a certain amount of fish each year for tap water. Good Bank quickly recovered costs and earned a lot of interest. At the same time, building the water plant created 250 jobs. After the plant was built, it hired over 100 workers to maintain the water supply system. You could say whether it's depositors who invested, residents using water, or workers in construction and production, everyone benefited greatly from this investment. The third stage of the island's economic development was establishing a government and starting international trade. As more people came to the island, friction between people increased. Fish thieves were still lurking around the island constantly, making life miserable for the islanders. So the islanders decided to form a government, establishing a senate through elections and setting up an army, police stations, and courts. To fund these institutions, the islanders agreed to pay some fish each year as taxes. Thus, this island became the United States of Macedonia, or the U.S. for short. The islanders knew full well that taxes reduced their disposable income and decreased their total savings and investments. But they believed the nation could provide a safe environment and a judicial system to resolve disputes, which brought more benefits to everyone. During this period, the tax burden was relatively light, and industry regulations were quite lenient. As goods production increased, businesses made profits, and islanders' purchasing power kept growing. As the economy boomed, the island's export capacity strengthened too. Explorers made contact with other islands, starting foreign trade, which further boosted economic growth. The island even outsourced fishing and manufacturing jobs to other islands, freeing up extra labor and capital to invest in other industries. All sorts of unheard of industries and services emerged. Real estate, companies, hospitals, and trading companies sprang up, bringing prosperity to the island. That concludes the development story of the island's economy. Next, let's explore part 2. How did this thriving economy collapse? This process can also be divided into 3 stages. Stage 1. The government overissued currency, causing inflation. There was a politician named Dip on the island. When running for senator, he promised islanders lots of free benefits, like free healthcare and government-built infrastructure. Eventually, Dip won the islanders' votes and became the speaker. But these benefits cost money, and government taxes weren't enough. So Dip came up with a brilliant idea: issue paper money. Islanders would deposit their fish in the bank's fish vault, and exchange them for paper notes. They could use the paper notes to buy goods and services, or exchange them back for fish at the bank. To issue more paper money, Dip hired technicians to make guan fish using the residents' saved fish, plus collected fish skins and bones. Dip decreed that the island bank could only exchange guan fish with islanders. Every 9 real fish could be turned into 10 guan fish, meaning 9 fish could back 10 paper notes. This created money out of thin air, making the currency worth less and less. Later, all politicians on the island learned this trick, making empty promises to islanders before taking office, then firing up the printing presses afterward. After a few years, the guan fish got smaller and smaller, eventually only half their original size. Since guan fish and paper money were equivalent, prices had to rise to make up for the shrinking fish. And so the island started experiencing inflation, with prices soaring. Islanders found the fish they withdrew from banks kept shrinking. Fewer people saved while more borrowed from banks. Meanwhile, companies began layoffs to protect profits. Soaring unemployment and high prices sparked protests. In response, the Senate imposed strict price caps. This made business harder, incomes fell, yet inflation worsened. So, the government's first mistake was overprinting money, disrupting the economy. Uncontrolled money printing inevitably causes inflation, leading to deadly problems like price surges, currency devaluation, and rising unemployment. This dragged the island from prosperity to economic ruin. Next, the collapse entered stage 2. The real estate bubble burst, and recession began. With currency constantly devaluing, islanders rushed to buy houses to protect their wealth from inflation. The housing boom drove up property prices. Many speculators jumped in, flipping properties for quick profits. Thus, more people bought homes, turning houses from living spaces into investment commodities. Banks saw a business opportunity and launched home loans. To banks, lending to home buyers seemed safer than funding uncertain entrepreneurs. Mortgages had built-in collateral. If borrowers defaulted, banks could seize houses. As long as prices didn't fall, selling these would still bring profits. With bank loans, buying homes got easier, and real estate-related industries flourished. The government thought this was a great way to boost the economy, so they fired up the printing presses again, creating 2 semi-official agencies, Fannie Mae and Freddie Mac. These agencies guaranteed mortgages and bought high-risk loans that banks didn't want to hold. The involvement of Fannie and Freddie gave commercial banks a shot in the arm. Interest rates kept dropping, and even people without income started taking loans to buy houses. Nothing paid better than flipping properties. Seeing island property prices soar, a venture capitalist named Manny launched a commercial loan called the Home Swap Program, also known as subprime loans. Manny's company offered larger loans to homeowners. They'd buy bigger houses. Manny's loans covered existing mortgages, and borrowers could spend leftover cash freely. So risky, reckless tone. As venture capital, Manny charged way higher interest than banks, giving investors fat returns. But his standards were super loose. He even lent to folks who couldn't afford down payments, because Manny believed as long as prices rose, it was easy money. So subprime loans got popular with islanders and investors. Even Fannie and Freddie invested in Manny's company, becoming the biggest backers. Prices kept skyrocketing. People thought they were in an economic golden age, but nobody could say exactly why. Some houses stopped selling, forcing developers to slash prices. Some thought prices peaked, so many decided to sell for quick profits. But here's the killer. Everyone had the same idea. Soon the island flooded with sellers, but nobody wanted depreciating property. Prices plunged off a cliff. Making it worse, the government jacked up loan rates, forcing people to repay even more. Many couldn't repay, went bankrupt, and ended up homeless. Banks or Manny's company repossessed these houses, turning them into bad debt. Manny and the agencies soon realized their money was gone for good. All they got back was worthless property nobody wanted. Finally, Fannie, Freddie, and Manny declared bankruptcy. Real estate-related industries collapsed. Mass layoffs hit construction workers, designers, appliance sellers. Masonia plunged into its worst economic crisis ever. The island is full of unemployed and homeless people. Finally, the government couldn't sit still. Economic advisors unanimously agreed that bold stimulus policies should be launched to restore the economy to its pre-housing crash state. So the story enters the third stage, government aid and consumption stimulus plans. The government believes the sharp drop in housing prices made people feel less wealthy, so they stopped spending. If the government could push up housing prices and provide consumption loans, people would naturally start spending and the economy could maintain its high growth trend. After the economy improves, the government would stop aid and stimulus, letting the economy run on its own. Fannie, Freddie, and Manny's company got government aid. The government fired up the printing press, injecting huge amounts of money. Bad debts were turned into national debt, and the national bank offered ultra-low rates and reduced property taxes, which would continue to generate loan demand, stop housing price declines, and get construction workers back to work. And the consumption loans provided by banks allowed people to maintain their previous spending levels, thus stabilizing commodity prices. All this aid and stimulus spending is the government's money. But where does the government get the money? It can only continue to overprint money. With fewer fish in the national bank, the government negotiated with other countries to constantly issue national bonds, borrowing fish from abroad. As long as foreigners were willing to trade fish for their worthless paper money, the island could keep living with consumption exceeding production. Tragically, government aid and consumption stimulus did almost nothing for production. This was bound to be a band-aid solution. Stimulus could only briefly boost consumption. As soon as the government tightened credit, the economy quickly started falling again. So, the island government had to launch an indefinite economic stimulus plan. But borrowed fish are limited, after all, and the official fish are already as small as they can be. Many on the island are deeply worried about the future. New businesses are getting scarcer, and everyone keeps cutting back on spending. And so the island's economy completely stagnated. Another mistake the island government made was thinking that stimulating consumption alone could drive economic growth. Actually, as we mentioned in part one, production and savings are the foundation of economic development. Only with enough savings do people dare to spend. So the government should increase production, boost savings, and expand demand. That's what drives consumption and naturally kickstarts economic growth. Plus, savings help regulate inflation to some extent. Inflation happens when the money supply far exceeds demand, leading to bad effects like rising prices. At that point, banks can hike savings interest rates to lure people into depositing cash, curb money flow, and slow inflation. So the island government ignored savings and production's role, naively thinking just stimulating consumption could drive growth. That's downright absurd. By now, you've probably realized this allegory mirrors the U.S. economy's state. In 2008, the U.S. hit a financial crisis. Stock prices of the big mortgage giants tanked, bond-holding financial firms lost big, and the U.S. government had to take over Fannie and Freddie to show crisis handling confidence. Right after the crisis broke out, the U.S. government rolled out a quantitative easing monetary policy. Quantitative easing's essence is the government pumping new funds into financial markets to push up prices. But in the author's eyes, quantitative easing is just a fancy term to mask inflation, and the U.S. relies too much on it. This won't lead to economic recovery. The author believes quantitative easing actually has two effects. First, it became a sneaky way for the Fed to monetize government debt. The U.S.'s first round of quantitative easing happened in late 2008, in 2009, buying about $2 trillion in bonds as a one-off plan. Those bonds were used to scoop up bad loans and back government-supported agencies. Then, the U.S. started multiple rounds of quantitative easing. Ongoing purchases of tons of Treasury bonds acted like a shot in the arm for the market, restoring economic confidence and halting asset price drops. But this actually nationalizes private and corporate debt, known as the debt monetization process. Through this move, it's seen as a nation's desperate struggle. Just like folks living on borrowed money will end up drowning in debt someday. But nations aren't like people. To keep the Fed from bankruptcy, the U.S. started hawking U.S. bonds globally. Under pressure from U.S. influence and the dollar's status, other countries had to bail out this bully neighbor, effectively internationalizing U.S. debt again and making the world share the crisis losses. Even though countries know this isn't sustainable, the U.S. has grandly repackaged quantitative easing as a normal tool for economic recovery. Second, quantitative easing's real purpose is merely prolonging the recession. In 2010, the Fed tried ending quantitative easing. Treasury purchases started decreasing. But everyone saw this as a sign of U.S. economic decline. The stock market quickly sold off. Then economists warned people the U.S. would face a double-dip recession. The Fed had no choice but to restart short-term quantitative easing that November. Whenever quantitative easing ended, the U.S. economy immediately slid downward. So the Fed finally decided on long-term quantitative easing until the economy fully recovered. Long-term QE boosted stocks and revived the housing market, but it did little for real economic development. Because the U.S. government artificially propped up asset prices without boosting production, expanding demand, or raising incomes. That's why stocks soared, while unemployment stayed high and real wages stalled. So the author believes quantitative easing isn't a cure for economic revival. Finally, back to the island story's ending. The island economy collapsed completely. Many countries realized loans to the island created no value, so nobody would lend fish to Macedonia anymore. This became the last straw. With fish supplies gone, the island saw hyperinflation, currency devaluation, scarce goods, and skyrocketing prices. Plus, government price controls made manufacturing and retail unprofitable. So a black market emerged, selling goods above legal prices. Islanders stopped saving, fish got eaten immediately after catching. With no savings, credit, or investment, even production equipment got bought by other countries using saved paper money. The island's economy returned to square one. Okay, that covers the main content of the Little Island Economics book. Before wrapping up today's interpretation, I want to mention that the book's authors, the Schiff brothers, belong to the Austrian School of Economics. The school's core principle advocates reduced government intervention and free economic development, which fundamentally differs from mainstream Keynesian economics. Keynesians view the Austrian school's economic models as oversimplified and inapplicable to our complex world. Meanwhile, the Austrian school accuses Keynesianism of being politically motivated and unable to genuinely contribute to economic progress. Regardless of which school you support, exploring different economic perspectives is valuable. It stimulates critical thinking and deepens our understanding of economics. Additionally, this book uses U.S. economic history as an allegorical blueprint, so its viewpoints have inherent specificity and limitations. Yet global economic development often shares common patterns. Still, the book offers valuable insights for reflecting on our current economic environment, and I hope it provides you with some meaningful inspiration. All right, that concludes our interpretation of The Little Island Economics. You'll find reading notes below the audio. See you tomorrow.